The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everybody. Hello, everybody. It is Mark Sebastian, the founder of Option Pit, and this is the Option Pit webinar of the month, Options Made Easy by me. Reminder that this is for, come on, this is one of those for educational, blah, blah, blah. It's not our fault if you aren't good. If you lose money, it is your fault if you lose money. Yada, 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 disclaimer, legalese. You can read it yourself. Basically, that's what that means. Now, for those of you who don't know me, this is me. I was a trader for about 10 years, and then I left the floor, and I still trade in a couple of small hedge funds, but my main job is working with people like you. I work with individuals, teaching them how professionals think and trade. One of the things that I really pay attention to is the fact that when I came off the floor, it actually took me a little bit to kind of get used to how the option market works from a retail perspective. Then I realized that traders are kind of taught all wrong how to look at options. And what I really want to teach you is, the overarching theme of what we're going to discuss today is that you have the power to make something happen. You have the power to act. You're the one that gets to decide to act. And that's really what we teach people to do, is how to harness the power of their ability to initiate. And that's really the key. I'm going to talk a little bit about why options exist. Options as insurance. I'm going to talk about the use of options for directional trading and buying versus selling. And I'm going to kind of give you my checklist for directional trading that I use. And we use it every day in the chat room, things like that. So if I were going to use one word to describe options, what word would I use? The answer is insurance. All right. Calls insure against the loss of dollars in a long position. Puts insure against the loss of dollars in a short position. And I'll get there. All right. Yeah. They aren't leverage. That's like saying, do you consider life insurance leverage, Elizabeth? Or car insurance leverage? They aren't. Yeah. No, it's an insurance policy. Now, you can choose to lever it. The insurance company uses the leverage, right? But you don't. So it's all about kind of how you use it, right? Insurance is insurance. The insurance company uses the float to get leverage. All right? You don't do that. So then, basics, I'm just going to hit a couple of basics because this is supposed to be made easy. I want to make sure everyone's coming from the same position, but we're going to get here. This is a long call, right? The blue line represents how a stock moves. The red line is a long call position. All right. So what you can see is, look at that spread there. All right. Look at this. This is the insurance cost. And then you can see it acts exactly the same once you make up for your insurance cost. Put, kind of the same thing. Here's the underlying asset. And then here's, you can see the cost. Real simple. Really simple. So, as you can see, calls insure calls insure against the loss of a stock position. All right. Puts insure against the loss on a short stock position. The price of an option is the price of the policy. That's it. Real simple. All right. So the Atomic, I have 2 books. All right, if you go on Google, I'll show you. You look up Mark, or you go to Amazon.com, and you go to, come on. Boy, what is the deal with Chrome? It's really slow. And you search Mark Sebastian books. I'm not Mark Weber, but here are my 2 books. Look, Trading Options for Edge and, Trading the Option Traders Hedge Fund, a business framework for trading equity index options, and Trading Options for Edge, profit from options and manage risk like a professional trading firm. Both of these books are good, and they're both based on this concept that you're dealing with an insurance product. And I think I did a pretty decent job with both books, and I'm proud of what I put out. So you can buy if you want to kind of get an idea of what I do. Those are two ways to start it. And so this concept of Atomic is the one-man insurance company. So when I buy options or sell, I'm buying an insurance policy. Just like when I insure a car, my house, or my life. All right. If I insure my car, I could, if you want to call this leverage, I pay $100 a month to insure 2 cars, and if I get in an accident, the payout on them, if I total the car, the payout to $20,000 or $40,000 or whatever, because I get a new car. Right? I pay a little bit in homeowners insurance every year, and if my house burns down, I would get a huge return on that. Now, what about when I sell options? Did I say insure? Ooh. Sorry about that. Thank you. You hired me to do, I always tell people, you hired me to teach you options, not how to spell. When I sell options, I become the insurance company. Right? I am now the one writing the policies. And I have to really make sure that I know what I'm doing when I'm writing these policies. And this is where using that ability to trade makes sense. So if I go to so I've got life insurance at Northwestern Mutual. All right. And when I called up my insurance guy, I said, hey, I want $1 million in term life. And they just said, sure, Mark, that's fine. Here's how much it is. You think that's what they said? And you think they said, hey, you buy insurance from us once, and we'll insure you forever, and the price will never change, and you don't have to pay us anymore. No. I have to pay a monthly. Every month I have to pay them to make sure I'm insured. And they came out and they did a health exam on me. They took my height, my weight, my who knows what. And they made sure that I was not, going to die next week if they were going to give me a bunch of term life. Now they don't know, right? I could have just dropped dead. Thankfully, I did not. And so just like an option seller, an insurance seller has to do the research. They have to know what they're doing. And they have to be aware of where they are on the time cycle. So like, I've got term life. Does my insurance policy last forever? No. If I cancel a policy, do I get all of my money back? It's a typo. Do I get all of my money back? No. Options, like all insurances, decay. There is a value that comes out of options. So this, you can actually see the decay. You can see the decay. And what I want you to notice, so here's kind of what it looks like today. There's a week from now, week after, week after, week after. You can see the policy is losing money. And it takes a stronger up move for me to win. So that's kind of the key here. So this is kind of how time decays over the life of an at-the-money option. Now, it's not all options, right? The initial options chart, the at-the-money option has this kind of famous chart where it really starts to lose money at 30 days to expiration, and then loses kind of an amazing amount with 8 days to go. But the further away you get from at the money, the more linear decay is. A lot of people don't realize that. Further away from at the money I go, the more linear decay becomes. Linear meaning more flat. All right. So then let's talk about, so just be aware that there's a time component to options that is really important. All right. That is, insurance companies that sell me an insurance policy are hoping I live long enough that they make money on my life insurance. All right. That's the decay function. If I'm an option seller, I'm actually almost thinking the other way. So let's talk about these policy costs, because this is the key. And this is where I really want to spend the bulk of the time on today. It's policy cost. So are all insurance policies the same? Does everybody pay the same amount for insurance? Right? Do I just blindly buy insurance from people? Do I shop for insurance? What do you think? Do I shop for insurance? Yeah. Yeah. I have to shop for the right kind of term, the right kind of whole life, if I want whole life. What company to go with. There's all sorts of stuff. I mean, you call up 4 different companies for auto insurance, they give you 4 different prices. Right? USAA or Allstate or State Farm or Esurance or Progressive or Geico. Geico apparently saves me 15% in 15 minutes. I don't know what that means. I don't think it's true. But hey, they've got a gecko. So, just like any insurance market, prices can be wrong. There are a lot of, if you study natural disasters, there's some very famous studies about hurricane insurance and flood insurance and how it's been mispriced on several times. Fire insurance was, I guess, out of whack a few years ago in California into a drought. So the key is option prices, just like the insurance market, can be too high, too cheap, or just right. The key to options is to figure it out. So insurance companies have these actuarial tables. They have, all these questions about you. Do you smoke? Are you fat? Are you skinny? Does your family have a history of heart problems or, other types of problems? What are you doing that is, that is so, what is your risk profile? Yeah. What about, and even what kind of car you drive will change the insurance, right? If I have a sports car, people assume I'm an idiot and they charge me more. All right. But you as an option trader do not have actuarial tables, do you? Anybody here got an option trader's actuarial table to figure out whether an option is a good price or a bad price? No. But they do have volatility. And volatility creates the size of the premium over parity. And just to make sure everyone knows what premium over parity is, I want you to look at the 220 calls. 220 calls are, Apple at this point is trading 228.36. The calls are 1040 at 1050. So I made them 1045. And they're $8.36 in the money. So the premium over parity is 209. There's probably a dividend in there somewhere. Because they're carrying some sort of carrying cost thing, because the calls are a little overpriced then. But there's the expiration premium over parity. Now, what is the premium over parity? So the 230 calls cost $4.20. What is the premium over parity for the Apple 230 calls? What is the premium over parity for the Apple 230 calls? Yeah, $4.20. They're $4.20. You can see right here. And since these calls are not in the money, they're all premium. They're all volatility. Or fluff, we used to call on the floor. We used to call it fluff. So, premium over parity fluctuates. So that's on top of the decay. So premium decays, that insurance premium decays every day, but then it also fluctuates. As volatility increases, premium over parity will increase. As volatility decreases, that premium over parity will decrease. So this volatility is called implied volatility, and I'm going to talk about implied. Implied volatility is the free market price of the insurance on a stock or index. So it's a free market, so we go on the SIBO or whatever, and we trade these options to find how much insurance premium should be in them. That is what you are doing when you buy or sell options, is you are determining the free market price of the insurance value of that option. It reads like a number, but is really a percent. So Apple volatility of 20.2 is actually 20.2%. All right, so let's talk about the volatility indexes. So there are a lot of platforms that have really good IV analytics for you. All right. IV Analytics. And then there are all these indexes that get listed by SIBO, NASDAQ, you name it, right? So the most famous index is called the VIX. Who here knows what the VIX is? If you're listening to an options seminar and you don't know what the VIX is, I mean, who really knows though? Right? The VIX is really, it is the value of insurance with a constant duration of 30 days. So instead, they call the VIX the fear gauge. I would call it the insurance index. How much does it cost to protect a portfolio using S&P options? But there are a lot of other cool indexes. But VIX is only on the S&P. Yes. But there are all sorts of other indexes. There is OIV, which is the oil VIX. There's GVZ, which is the gold VIX. RVX is the Russell VIX. VXN is the VIX of the NDX, the NASDAQ 100. And there are VIXs on individual names and ETFs. So there is the Apple VIX. There's an EM VIX, an EWZ VIX. There is VIX on currency. It is a massive list. Yeah, it's a massive list. Here, let me see if I can find this. So there's a whole SIBO global indexes. I mean, it's amazing how many indexes they have. I don't know why Chrome is so slow. Oh my gosh. There you go. So look, there's commodity ETF, there's VIXs on commodities, currencies, equity, and fixed income. It's amazing. They have 205 volatility indexes. British Pound Volatility Index, Binary Option Index, you name it. So the point is that even if you have how do they think the reshuffling of the various stocks will be affected? I'm not sure what you're asking. So the point is, here's the VIX. Now I want to point out something. This blue line, you know what this blue line is? It's the 200-day moving average. Oh, a little bit, yeah. It doesn't have much of an effect. It's the 200-day moving average, yeah. Now, does that look like it has a lot of movement to it? No. I mean, this almost looks flat. And but think about this. Within this 200-day moving average that's super flat, look at all the movement. But there is this mean reverting characteristic to the VIX and volatility. So when premiums are really cheap, you have to ask yourself, is this a time to be selling? And when premiums are really expensive, you have to be asking yourself, is this the time to be buying? Well, you can make money on owning volatility if you know what you're doing. Or selling. So there is just so much to be made on understanding that when it's crazy high, it's probably too expensive, and when it's crazy low, it's probably too cheap. So there's VIX. Now I want to show you VXAPL. So it is not a fluke that volatility line is flat. Yeah. This is the way you price options. Right? If you're not pricing options using volatility, then you're not pricing options properly. You're probably setting yourself up to lose. So now what I'm looking at is buying, when stuff is down here, it might be too cheap. It's probably not a great policy to sell. Right? Look at this. Does that look like it's an over or underpriced policy? What about over in here? We'll look at it in a little more detail in a bit. So, buy vol low and sell vol high. Kind of, but not exactly. Generally speaking, I actually usually say sell vol high and sell vol low and buy it lower, buy vol high and sell it higher, but not when I'm trading directionally, which is what we're covering here today. So I don't care what you want to do, covered calls, cash secured puts, spreads. If you are not looking at implied volatility, you are leaving money on the table. You're probably selling credit spreads too cheap. All right. There are options that should be sold. My friend Don used to say this. There are options that should be sold and options that should not be sold. Don't sell options that should not be sold. Most options should be sold. Some options should be bought. A lot of options should not be sold. So let's look at Apple again with kind of this new thought process. Right? Do we think, based on what we know, here's Apple earnings, right after Apple earnings. Were those options that should be sold or bought? Probably bought. Right. But then look here. Here is kind of the run up into, here's what happened for several weeks before earnings. What about that? Was that stuff to be sold or bought? You think I could do some weekly option debit spreads or credit spreads over this period of time here? Or like some iron condor type stuff? I don't know. I think that this is probably where you could have sold a put spread. Yeah, probably. I don't like trading actual earnings. This is the actual earnings. So I would have been trading in here. And looking to sell, weekly put spreads or, credit spreads or some sort of condor trade. And then I would have been out of it. And then when Apple had those great earnings and then rallied, I said to myself, why is the premium so cheap? This thing's just going to go, Apple has what I like to call FOMO MOMO. You guys ever heard of FOMO MOMO? What do you think FOMO MOMO is? It is the fear of missing out momentum trade. So yeah, it's the fear. It's the FOMO FOMO trade. Say FOMO MOMO 10 times fast without sounding like an idiot. Um, so it was a perfect FOMO MOMO setup. I'm gonna start using that as a term. It's got FOMO MOMO. And then that was an easy time to buy options. It really was. All right, and we can go back and look. So now let's talk buying options. There are times options can be a good buy, especially when IV is at year low levels. I have absolutely found that trading after earnings, premium gets oversold, and it can be a great buy. It really can. I would strongly suggest kind of examining that, and we'll look at kind of some stuff here. So let's talk about price, IV, and movement. So I want to talk about here's another look at that low vol that we were just looking at right here. And you can see they really sold this stuff down. Even here it got sold down. And if I bought calls, how did I do buying calls last month or so? Well, take a look. The white line is the speed of the stock. The red line is the cost of those options. And the top line is direction. So it's moving quickly, insurance is cheap, and it's going up. You tell me what I want to do. Yeah, no kidding. Calls and calendars is all I did. That run up in Apple and in Square and in NVIDIA and a few of these other names. It's literally just been long calls or long call calendars. I'll show you, and I'm going to show you one that I've got on right now that's working. So when directional trading, when policies are cheap, I buy calls and puts. When policies are expensive, I use put spreads or call spreads, and I become a net premium seller. You can also use cash secured puts or covered calls. I think that covered calls and cash secured puts are better than actually buying the stock, but on the whole, they're not as efficient for capital as put spreads and call spreads and option purchases. So here is another one I liked in MasterCard. So here is MasterCard options. Right here was where I set this trade up. It was right after we got earnings out of PayPal and Square and all those names. What do you think you want to do here? What would you want to do? I can show you two ways to do this. All right. And I will, one second, discard. So I'll show you two ways to do this. I do some part-time writing for thestreet.com. And a very simple trade I said was, here it is, the 28th, buy the OCK 220 calls for 272. Now, the more complex way that I set up a trade like that would be to do a call calendar. So I'll show you this. Come on. That's why I don't use Sterling anymore. Well, anyway, point is, I did a 220 call calendar. I had the SEPOC, and that is working as well. So now here's Nike. Now, what's the story with Nike? You guys see it dropped today. Well, I'll tell you, generally speaking, I tend to ignore noise. And like Mr. Kaepernick or not, in the end, it really doesn't matter, and it's going to have no effect on whether Nike sells a pair of shoes. Yeah. So I just think that's so I looked and I said I had a couple ideas, but take a look. Is that implied volatility expensive or cheap? What do you think? Is that high vol or low vol? Yeah, I sold. I was a put spread seller. Yeah. So today the red line is implied volatility. So this is that insurance premium cost. And I think the stock's going to go up, or at a minimum, it's probably not going to drop a lot more. So I wanted to sell instead of buy. So I set up a put spread. I sold the 79, 77 and a half put spread at like 41 cents. So 1.5 points wide, 41 cents premium. That's not bad, right? I'm basically risking $1.10 to make 40 cents. That's not terrible on a sale. And I'm out of the money by about $1. Yeah, 37% return on risk. So real simple trade. So now, here is my kind of checklist, my easy checklist. So if you want to get better at trading directionally, here's the checklist. And we've covered 4 of these, right? What is the story of the stock, right? Nike, Colin Kaepernick. MasterCard. The payment industry is exploding. Apple, biggest company in the world, blowout earnings. So what is the directional opinion? Going up, going down. Real easy. And that should be based on the story. What is the speed? Is it going up fast or slow? Is it going down fast or slow? And then what is the cost of those insurance options? What's the insurance price? What is the implied volatility? If the insurance price is high relative to speed, I want to be looking to sell. And if it's low, then I'm going to be looking to buy. Then the next steps are what is the best strike, what is the best term to buy or sell, and what is the best spread. So what do not just at the money, what do I want to buy? And then not just and then what month, and then what is the actual best trade, right? So let's develop a trade using steps 1 through 4. I'm going to restart Sterling. So somebody come up with a directional a stock, and we're going to do our steps. But before we do, I want to tell you about what I'm offering. So we are going to be doing a 5-part class called Options Made Easy. And it is going to be building on what we've covered tonight. Just a lot more detail, a lot more in-depth coverage of, really how to make options. So we started with some directional trading. We're going to dig deeper in directional trading. We're going to dig deeper into some spreads. So building good credit and debit spread trades. We'll probably cover some more complex trades. And then we're actually going to do a bunch on portfolio management, building a portfolio, setting up risk parameters around a portfolio. The concept of, you guys know what VAR is, value at risk. We're going to teach you all these skills. So 5 60 to 90 minute classes teaching you our toolkit. You'll get the recordings and the educational materials included. There'll be homework and email support. So we're going to make sure that you know what you're doing. And then at the end, you get one 20-minute one-on-one session with me. And it includes, it's going to be on Tuesdays over a 5-week period. So just once a week for 5 weeks. And then you get 1 month of OptionPit Live included. And which is $125. You get a 20-minute session with me, which is worth $200. And we're going to sell the course at $397 when it goes into the store. So $400 plus $200 plus $125. So that is $725, and it's yours for $197. So you get to watch it live and get the recordings for half of what we're going to charge it when it goes in the store. And then you're going to use code 25_off. So 25_off, and you take an extra $25 off. It'll probably be $5:30 Eastern. And you go to optionpitmembers.com/EASYO. EASYO. EASYO. All right. So that's optionpitmembers.com/EASYO. And if you hate the class, you think it's garbage, I'll give you your money back. All right, so let's talk about any questions on the class. All right, then let's develop a directional trade. Yeah, historical volatility is the speed of the stock. All right, so there's definitely something wrong with Sterling Trader. We'll use TradeHawk, which is fine. I like TradeHawk. My Hawk Command Center. Tell you what I want to talk is, let's pick one that has a volatility index. How about gold? So I want to pull up GLD here. And then I want to pull up a stock chart. And the symbol for gold vol is GVZ. I'm going to change this to 5 years. All right, so take a look at this. Does gold vol look like it's high, low, or medium? Yeah, it certainly does not look high. And then if I pull up the H-vol matrix on GVZ, not being helpful today. Oh, I want gold, not GVZ. Sorry, that's why. All right. ATR is one way. I like looking at overnight and intraday H-vol. But I'm going to look at close. And you can see the movement is really low. ATR off. So if I look 15-day of close, historical vol is about 1285. And so close to close, it's been moving at 1285. And my GVZ is coming in at 1142. So do I want to, if I think I have will this teach me basic options too? Will I be able to trade options? Yes. US dollar hurting gold. So I think gold's going to go lower and premium is cheap. So what do I want to do? Real simple. I'm gonna put up a bearish trade. I mean, take a look at this. Gold's off 58 cents today. I can buy the October. So these have a month and a half to go, and they cost me $1. They cost less than 1% of the value. The at the money put costs less than 1% of the value of GLD. Does that seem like? And we know that it's moving close to close higher than implied volatility's pricing. You think that's a good reason to buy a put? There you have it. We developed a position. All right, folks. Like I said, I think everybody should take the course. optionpitmembers.com/EasyO. And like I said, you get one 20-minute session with me at the end and a month of chat room access, which I'm in almost every day. You get to listen to this golden voice talk every day. So any other questions on the course? Yes, it'll start off. It will teach. I think it'll teach you a lot of good stuff. What platform does the tools work on? This will work on Toss, TradeHawk, uh, Sterling, you name it. These tools are great for everything. What is a good time to buy neutral on SPX? Read the book. And yes, it'll cover some. Does the month in the room start ASAP or after the training sessions? You can start it whenever you want. You can start it up to the before the third session. So I'll give you a couple of weeks to get yourself acclimated, and then you can jump in. And you can take the 20 minutes with me at the end. Totally worth it. So yeah, you're getting $725 worth of stuff for $177. That's when I do the math, I believe that's like 75% off. Yeah, and thank you. Which book did you read? Both of them, or just the old one? Oh, the new one. I'm glad you like it. Leave a review on Amazon then, please. I've got all these 5 stars, and then there's 2 jerks that gave a 1 star to try and tank my rating. That's a question for a financial advisor, Abdullah. Is the next section next Tuesday? No. It is I believe it's gonna start on the 18th. I could be wrong. I will double check. It's either the 11th or the 18th. And like I said, all of these are recorded, and you get to keep them. All right? Great. You don't get anything for not putting a 1 star on Amazon. I'm not in the business of bribing people. Tell you what, if you buy the book and send me a receipt, I'll give you a 2-week trial to Option Pit Live. My book is not a beginner book. It should be the 2nd or 3rd book you buy. But if you do buy the book, I'll give you a 2-week trial. I don't care if you give me a 1 star or a 5 star. I'm not in the business of bribing. Thank you. That's really cool. You know what? What book are you suggesting? Oh, my book. Email me if you want to know some beginner books. You can just send me a screenshot of you with your holding it. Oh, I have 2 books. Yeah. I have The Option Trader's Hedge Fund and then Trading Options for Edge by Mark Sebastian. 2 good books. All right. All right. Yeah, shoot me an email and we can. My email is mark@optionpit.com if you have questions. Feel free to email me and I'm happy to help out. What's the new vol letter? That's the Volatility newsletter. It's mostly around VIX and VXX. When's the discount end? Friday. Yeah, if you're a beginner, you should take this Made Easy class. We do everything as a crescendo, just like this presentation. You notice I started off real simple and then kind of built on concepts. That's the way we do all of our coursework. I have no idea. It hasn't been around for a year. So you can shoot us an email and we'll be happy to send you the historical trades. Can I buy the course after I'll be done with your book? Well, what you can do is buy the course, and then if you're not ready, you can watch it later. All right. Well, I'm glad you liked the webinar. All right, everybody. I think that's. Let's see. We got a clean hour in. I want to thank everybody for being patient. Sorry about the snafu with the registration, and I hope everybody has a. I hope everybody has a great evening. And go Bears, go Cubs.